Hello everyone, welcome to the September 2025 RBI Circular Part 1 video. So we'll be covering the RBI circulars. Okay, these are the total circulars that we need to cover in September month, right? And I'll be covering some news from the RBI website as well, right? There will be two parts. This is the first part of the video. Let's start with the first one. This is about returns, Department of Payment Settlement System regarding the submission in the CIMS. So returns are to be submitted now in the CIMS. What is CIMS? Centralized Information Management System. Centralized Information Management System. So here we can see that the Centralized Information Management System is the Reserve Bank of India's single digital platform for collecting, storing, managing and analyzing the data from the different regulated entities like bank and NBFCs, right? So this is a platform where all the data will be collected and analyzed, right? And it is having advanced technologies like big data and other analytical tools as well, just to analyze the data very well, right? So this is a centralized platform where RBI will be gathering the data and analyzing it. So here we can see that the return names are internet banking return and mobile banking return. Now the frequency is monthly, so the regulated entities need to submit the internet banking return and mobile banking return on a monthly frequency. The due date here is to be submitted by 7th of the succeeding month. So let's suppose for the August 2025, the return date will be 7th of September, right? And this return you need to submit on the Centralized Information Management System CIMS platform of Reserve Bank of India. So this is the news basically, right? Now earlier also we have discussed about the CIMS portal in my finance current affairs sessions, right? So can be very important for your upcoming examination, and whatever I just delivered to you is written in this particular image as well, right? This also we have covered earlier. So basically what's the news is, it is regarding the Centralized Information Management System. The regulated entities now need to submit two types of return, internet banking and mobile banking return on this CIMS portal, right? So by every 7th of the next month, you need to submit these two returns on this particular platform. Please do remember this news, okay? Next one is your regulation of the Payment Aggregator Direction 2025. So payment aggregators are the backbone of Indian economy, right? Payment aggregators are doing a very important job here. We'll be understanding about what payment aggregators are doing and what kind of regulations are now applicable on the payment aggregators. So this particular circular is divided into 6 parts, right? I'll be also telling you the most important portion from this particular circular on which you can get a direct question in your examination. Okay guys, so the effective date is, there is no such date, it is effective immediately, right? It is effective immediately. This will be applicable on all the banks and non-banks who are payment aggregators. So all the banks and the non-bank entities who are doing the business of payment aggregator. All the authorized dealer banks and the scheduled commercial banks engaging with the PA entities. So all the AD and scheduled commercial banks who are engaging with these payment aggregators also need to follow these guidelines, right? So this is effective immediately. The name is RBI Regulation of Payment Aggregator Direction 2025, effective immediately, and this is the applicability. This is the applicability, right? I have pasted all the screenshots as well from the circular itself, so that you don't have to go to the circular PDF again and again. What you can do is just download this PDF, have a quick reading related to the summary notes, and you can have a detailed understanding from the circulars as well. I have marked each and everything which can be important for you guys. Now let's understand the definitions as well. So payment aggregator, what do you mean by a payment aggregator? A person, an entity who is aggregating the payment on behalf of the merchants, right? A person, an entity aggregating the payments on behalf of the merchants. Let's suppose there is a merchant. I've started my own business. I've started my company. So what I'm doing is I'm receiving multiple payments from customers. Now the payments can be offline as well as online, right? The payments can be offline as well as the online payments. Now there is a problem with payment and reconciliations. That's why I need a third party who can organize these payments, who can aggregate these payments and credit to my bank account. So here we are having a payment aggregator. Here we are having a payment aggregator who will be facilitating this transaction. And will be making payment for the merchant. Basically, this payment aggregator is collecting the funds and it's delivering that payments to the merchants. That's what the main purpose of a payment aggregator is. Right? So let's have a quick look at the definition as well. An entity that facilitates the aggregation of payment. You need to aggregate the payment and then you need to facilitate it. So the payments are being made by the customers to the merchants through one or more payment channels. It can be through physical mode, it can be through virtual mode, right? Why? Because these customers have purchased goods and services. Just like you purchased a service from me, you have made an online payment and there was a payment aggregator in between, right? So this payment aggregator will definitely subsequently settle the collected funds to the merchants here. Now there are many types of payment aggregator. It can be physical, it can be online, it can be cross-border. So let's understand what are the categories of the payment aggregator. The first one will be payment aggregator physical. Now by physical, I mean there is a close proximity between the payment instrument and the device. Now what can be the device? Let's suppose we went to a showroom, let's suppose West Side, right? Or maybe Reliance Smart. We have done some shopping and the device is there, right? The particular device is there in the showroom, right? Where you make the payment. How you make the payment? What is your payment instrument? It can be debit card. It can be maybe credit card, right? So you are making payment via debit card or credit card and there is a device from which you are making the payment, which is facilitating the transaction, right? This is the payment aggregator's device. So what you will be doing is either you will be scratching your card, right? You will be swiping your card basically, or if that's a wireless technology, then what you'll do is you'll just place your card on that machine and the payment will be facilitated, right? So can I say that you will be swiping your card in this device, or your card will be in close proximity with this device? So these kind of payment aggregators are PA physical, PAP. We call them PAP, payment aggregator physical, where there is a close proximity between the device and the payment instrument, right? Just like that, let's suppose you are doing online shopping, you are buying something from Amazon or Flipkart. Then again you are using your debit card or credit card, but now the device is nowhere close to your payment instrument, right? Your credit card is not at all at the close proximity with that device. However, you are making an online payment. So you're just giving your card credentials like the card number, the expiry date, the CVV code and the PIN of the card. And that's how you facilitate the transaction. So here the device and the payment instrument are not present in the close proximity. So that's what the payment aggregator online is, right? And the third category is payment aggregator cross-border. Now as the name says it all, this payment aggregator is facilitating the cross-border transactions, right? Outside the country, outside India. Let's suppose if someone is sending me money from United States of America or maybe United Kingdom, then a payment aggregator cross-border will be facilitating such kind of transaction. Now payment aggregator cross-border facilitating the inward transaction, there are again two subcategories. Whether I'm receiving the money, whether it's an inward transaction, or whether I'm sending the money, right? So inward transaction, payment aggregator cross-border inward transaction, and payment aggregator cross-border outward transaction. There are two subcategories here, right? So these are the three types of payment aggregator: physical, online and cross-border. Physical, device and the payment instrument are in close proximity. Online, device and the payment instrument are not at all in the close proximity, and the cross-border, as the name says it all, it is facilitating the cross-border transaction. It can be inward, it can be outward as well, right? I hope it's clear. So I have summarized these definitions as well for you in a single page. You don't have to go through the circular completely, and that's what the beauty of these lectures and the PDF notes are, that we summarize each and everything, and we also paste the screenshots from your RBI circular so that you can get a feel that you are actually reading from the RBI circular only, right? Then there is a term payment gateway. So we were discussing about payment aggregators. Now what is payment gateway? It's nothing but they are not aggregating, they are not handling any kind of fund, but they are just giving the tech infrastructure. They are just giving the tech infrastructure for the payments. They are not at all handling the funds, whereas payment aggregators are actually handling the funds on behalf of the merchants. That's the difference, right? That's the difference. Now there are some more definitions like cash on delivery transaction. So I think COD आप मुझसे better समझते हो, right? Cash on delivery, आपने transaction कर दिया, you did that transaction, goods and services आपके घर तक आ गए, and then you will be making the payment, right? Mostly through the legal tender of India, that means in the currency notes. Then contact point verification. Now let's suppose in Delhi, right, in gully number 71, there is a merchant. Now who knows that in gully number 71 there is a merchant? So that's why we need to do a contact point verification, CPV, contact point verification, that the physical verification, it is nothing but the physical verification of the address or the place of business of the merchant, so that we can conclude that this merchant actually exists. It's a genuine transaction, it's a genuine person or a business. It's not at all a fake business, right? So as to avoid the cases of fraud, the contact point verification is also done by the payment aggregator, right? Physically verifying the merchant, here. Then we have the definition of e-commerce. So buying and selling of goods, including the digital products at a digital or a electronic network, is what e-commerce is, just like Amazon and Flipkart, right? Inward transaction we have already discussed, and marketplace, it's nothing but an e-commerce entity like Amazon Marketplace, which is providing a IT platform to facilitate transaction between buyer and seller. That's what the Amazon is doing. That's what Flipkart is doing. They are a marketplace, right? They are a marketplace. They are facilitating a transaction. They are connecting the buyer and seller with each other via the information technology, right? Then merchant, obviously the person who is selling the goods and services, the business, is what is merchant is all about here, right? Outward transaction, again we have discussed, and payment channel, it can be through any manner, right? Through which payment instruction is initiated and processed in the payment system. So it can be via any manner, it can be online, it can be offline, it can be via debit card, it can be via credit card, right? Let's start with chapter 2. Right, so in chapter 1, the basics like the applicability, the title of the circular was there and the definitions were there. In chapter 2, it is related to authorization and capital requirement. The capital requirement portion can be very, very important for your examination. Authorization. Bank do not require authorization for carrying the payment aggregator business. There is no such authorization requirement for the bank to carry the PA business. Bank can initiate the PA business. However, if you are a non-bank payment aggregator, first you need to take NOC from the regulator. First you need to take no objection certificate from the RBI, the regulator. And once you are done with taking the NOC, then within 45 days you can make an application on the Pravah portal to apply for the same, right? So first you need to take NOC, non-objection certificate, in case if you are a non-bank payment aggregator. Once you are done with the NOC within 45 days, what you can do is you can apply on the Pravah portal of Reserve Bank of India, right? So non-bank payment aggregator must be an Indian company. You cannot be a foreign company. You need to be an Indian company. And what do you mean by Indian company? You are registered in the Companies Act 2013, right? The India's Companies Act 2013. Okay, so if you are a bank, no need of authorization to carry the PA business. If you are a non-bank, first you need to take the NOC. Then you need the 45 days you need to apply on the Pravah portal. You need to be an Indian company if you are a non-bank payment aggregator registered under the Companies Act 2013, right? Now entities doing only the payment aggregator physical only business need to apply by 31st December 2025. That is the timeline. If you are unable to do so, you need to wind up your business by 28th February 2026. So by February end 2026, if you are not applying, you need to wind up the business, right? So that's what is written in the circular as well. You can have a quick look here, right? then capital requirement can be the most important thing for you guys for your examination purpose. At the time of application, whenever you are making the application for the payment aggregator, let's suppose I want to start my payment aggregator business. What is the requirement? I need to have a net worth. I need to have a net worth of at least 15 crore at the time of application. That means I need to have at least 15 khokha in my pocket, 15 crore in my pocket at the time of application. That's the number one requirement. However, this is not the only requirement. At the time of application, you need to have 15 crore in your pocket. But in 3 years, at the end of the third year, you need to have the net worth equal to 25 crore. That means you should be growing, right? From 15 crore, at least you need to gain 10 more crore in terms of net worth at the end of third year. That's the minimum requirement that you need to have. Now, these two things can be very, very important. You can get a direct question in the examination related to the capital requirements, right? Now, it's not like that once you are touched 15 crore, that's okay, you can go down, or once you have touched 25 crore by the end of third year, you can go down. No, it should be maintained continuously. There should not be any kind of drawdown from this bare minimum. Now, net worth will be also including compulsorily convertible preference share. What is compulsorily convertible preference shares? Those preference shares that will be compulsorily converted into equity, right? So obviously, if it's a part of equity, then it will be a part of net worth. That's why compulsorily convertible preference shares, again, they are prospective equity shares only. No doubt there is a compulsion that we need to convert it into equity, so they are as good as a prospective equity. That's why we take it in the calculation of net worth. But we won't be considering the deferred tax asset. Okay, we won't be considering the deferred tax asset in the net worth. Entities with FDI need to comply with the FDI policy as well. So please guys do remember this particular capital requirement here, right? Then conduct of the payment aggregator business. How we are going to conduct the payment aggregator business is mentioned in chapter 3 of this. So what chapter 3 is stating here is the payment aggregator business needs to be professionally managed. It needs to be professionally managed. The promoters, the directors must meet the fit and proper criteria. The promoters of the payment aggregator, the directors of the payment aggregator needs to meet a fit and proper criteria that RBI has stated. They should have integrity, they should have financial soundness, no conflict, no confliction should be there, no conviction should be there, no conflict of interest should be there, right? And there is a particular requirement that they need to follow here, that they should be financially, right? It's not like that you are qualified. You will be disqualified if you are financially not sound, right? If you are convicted for any offense involving the moral turpitude, adjudicated insolvent and not discharged. You are an insolvent, you are adjudicated as an insolvent, and as of now you are not discharged. So these are conditions that you need to fulfill. You should not be falling in the disqualified area here, right? In order to be the promoter or direction of payment aggregator. Why? Because there is a huge amount of risk. You are dealing with people's money. What you are doing is you are aggregating the payments and making the payment to the merchant. So there is a risk, right? So definitely RBI has ensured that the payment aggregator should be professionally managed here. Then dispute resolution, dispute management framework should be there related to the failed transaction. Let's suppose a customer has did a transaction, customer is doing a transaction and the transaction got failed. So whether the money got refunded or not, any kind of chargeback was created or not, and TAT compliance, and so many things are there related to the dispute management. Basically, you need to have a very good dispute management system here. Coming to the general direction, payment aggregator shall aggregate funds only from the contracted merchant. So every payment aggregator has some contracted merchants, and you can aggregate funds on behalf of the registered contracted merchants only from those merchants with whom you have signed a contract, basically, right? With whom you have entered a contract. It's not like that. Let's suppose I'm a new merchant. Now the payment aggregator won't be accepting my payments. They won't be aggregating my funds. Why? Because I'm not a contracted merchant. So that's the number one requirement here. Now, payment aggregator cannot do a marketplace business. Why? Because if they do so, it will be completely a conflict of interest. They are facilitators to the marketplace business. They cannot enter into directly marketplace business. Again, they need to follow the merchant discount rates as well rules and display the charges clearly. So what they are doing is they are charging a small fees from the merchants. Why? Because they are facilitating the transaction, they are aggregating the transactions and paying to the merchant. So MDR means merchant discount rules, rates, right? So they need to clearly display the charges, whatever they are charging from the merchants. Okay. Now let's discuss about some more general guidelines. So there will be no transaction limit by the payment aggregator. It's the bank responsibility to set the transaction limit. Plus, no ATM pin for card not present transaction. If the card is not present, you don't have to ask for the ATM pin. Rather, you can go through any other dynamic method like OTP verification and so on. Refund to the original payment method unless instructed otherwise. And payment gateways not under the scope. Payment gateways are definitely not under the scope. This guideline is specifically for the payment aggregator. However, they are also recommended to follow the baseline guidelines. Still, they can follow the baseline guidelines. It will be definitely good, right? Here is the difference between a payment gateway and the payment aggregator. Basically, the payment gateway is providing infrastructure and payment aggregator is actually aggregating the payments and paying to the merchants. That is the major difference, right? Now, if I talk about the payment aggregator cross-border PACB, there are some specific guidelines related to payment aggregator cross-border. The maximum per transaction limit will be 25 lakh. Important. Maximum per transaction limit will be 25 lakh. There are some specific guidelines for the payment aggregator cross-border as well. Why? Because considering the amount of risk in it. Then settlement will be only through the AD category 1 banks. Only they are allowed to deal in the foreign currencies. Inward and outward funds must be kept separate. So whatever is coming in needs to be kept separate. Whatever is going out, outflow and inflow accounts need to be separated. No foreign currency purchase or sale except with the AD category 1. You cannot purchase or sell the foreign currency without involving the AD banks, right? Authorized dealer, you can take foreign currency purchase and sale with the AD banks only, authorized dealer banks only, right? And there are some more general guidelines specific to the cross-border transaction. So now the circular is more of process oriented rather than the limit based. Mostly the questions that are coming in our examination are limit based, right? Date oriented, limit oriented or any concept oriented. But now the rest of the portion of the circular is more of a procedural in nature rather than the limit based. Then there are some due diligence guidelines as well, right? They need to follow the RBI Master Direction on KYC 2016 for the due diligence, right? They can retrieve merchants KYC from the CKYC platform as well. And there is a relaxed requirement. There is a simplified due diligence requirement for the small merchants. If your turnover is less than or equal to 40 lakhs rupees and your exports are less than equal to 5 lakh rupees, then simplified due diligence criteria is there for you guys. If you have onboarded any kind of merchant before 31st December 2025, must be KYC compliant. This merchant must be KYC compliant by 31st December 2026, right? So by 2026 at least you are able to do the full KYC of this particular merchant, right? Then there is a requirement of escrow account as well. So non-bank payment aggregator, if you are a non-bank payment aggregator, then you must maintain an escrow account with the scheduled commercial bank, that to a domestic scheduled commercial bank. Or you can even maintain the escrow account with the AD category 1 bank if you are a payment aggregator cross-border, right? So if you are a non-bank payment aggregator, you need to have an escrow account with the scheduled commercial bank, that to domestic SCBs. And if you are a payment aggregator cross-border platform, then you need to have it with the authorized dealer 1 banks, right? And special accounts will be there for both inward and outward collection. That's the major rule here. Now there are some more general rules related to the payment aggregator cross-border. So escrow account cannot be used for the COD transaction. You won't be using that escrow account for the cash on delivery transactions. The very first requirement. Separate escrow account should be there for payment aggregator cross-border and for the domestic payment aggregator. Let's suppose you are receiving domestic payments, then a separate escrow account for the domestic payment and separate escrow account if you are also a payment aggregator cross-border. Auditor certification is required in escrow balance to count as NDTL for the bank. Now what is the meaning of this line? This escrow account, whatever balance is there in your escrow account will also be counted as NDTL. That means you need to maintain CRR and SLR compliance. You need to also do the CRR and SLR compliance on this NDTL balance, right? Whatever amount you are having in the escrow account, you need to have that included in the calculation of the CRR and SLR, right? Now these are some of the escrow account requirements as well, like escrow account domestic needs to be opened with scheduled commercial bank. For outward and inward collection, if you are a cross border, then you can maintain it with the authorized dealer category 1 scheduled commercial banks, right? And most of the things are I can say here process oriented now in this particular circular, right? Then there are some general guidelines as well. Most of the things we have already discussed in the summarized manner. This is a part of section 18, right? Like no COD transaction in the escrow account, right? Separation of the domestic and the cross border, we have already discussed this one as well. So now most of the things are process oriented only. Here there is a clear cut clarification that on the net demand and time liability you need to again account for the CRR and the SLR, right? Then at the end of this circular I have given you some important pointers as well for your examination purpose. Then there is annexure 1 and annexure 2. Don't go into too much detail of the process oriented things. Rather focus more on the dates and the, I will say, data related things from the circular. It will be more beneficial for your examination. Next one is participation. Next circular is participation of standalone primary dealer in non-deliverable rupee derivative market. Now first, let's try to understand what is the change, and then we'll be discussing about this non-deliverable rupee derivative market. There is a change. Earlier we used to have only authorized dealer category 1 banks. In this particular area, we used to have only authorized dealer category 1 banks. Now RBI has authorized the AD category 3 as well. We can clearly see on a review decided that the standalone primary dealer authorized dealer category 3 shall also be eligible to transact in the NDDCs involving the rupee, right? So now they have added authorized dealer category 3 banks as well, and that's what the amendment is. So in all the paragraph, mostly in all the paragraph, what they have done is they have included this line by standalone primary dealer AD category 3 as well, right? So that's the amendment here. Now for those who don't know what non-deliverable, that means there will not be any kind of physical delivery. Rupee derivative market, NDDCs. It's nothing but it's referred to a trading in the currency derivative. Now what is a derivative? A financial instrument or a financial contract that derives its value from an underlying asset, right? So it's a currency derivative. Definitely in the underlying there will be a currency. There will be a currency in the underlying as an underlying asset. On this currency we have made a derivative contract. That's what currency derivative is all about, right? So a non-deliverable derivative market refers to trading in currency derivatives. What I'm doing, I'm trading in currency derivative. Maybe I want to hedge a portion in INR. That's why I'm trading in currency derivative. Let's suppose I am from UK. I want to hedge a portion of a contract in INR terms, right? I want to create a hedge against INR. So I can enter into this kind of currency derivative where settlement is done without actual delivery. That we all know, because in the name itself it's non-deliverable. So definitely without actual delivery will be there. There will be a mark-to-market settlement, a net settlement instead of physical deliveries, right? So there won't be any actual delivery of the underlying currency because the underlying currency is usually rupee here, right? The underlying currency is rupee here, INR. So how can we do a net settlement, right? How can we do a physical settlement? Now nobody will be physically sending cash in INR to the UK or USA entities, right? If they have entered into a contract, it will always be a net settlement. So these contracts are linked to Indian rupees only. So Indian rupees is my underlying currency and I have made a contract, a derivative contract on this underlying Indian rupee, which is a currency. Now they are settled in foreign currency only, usually USD or maybe pound. right? They are not settled in the INR. So that's what the major purpose is, and why they are entering, why the offshore investors are entering into this particular agreement. Maybe to hedge, maybe to do the speculation on the INR movement, right? So INR is moving quite aggressively nowadays. If they want to hedge a portion in INR, or even if they want to speculate, they can do it via non-deliverable rupee derivative market. So the major amendment is, and this is important, that now AD category 3 third bank, AD category 3 bank is also permitted, right? Please do remember this one. Next is related to your RBI authentication mechanism for the digital payment transaction directions. Now, if you are making any kind of digital payment transaction, if you are doing any kind of digital transaction, what should be the authentication mechanism, right? How can you authenticate the transaction is what we are going to study in this particular direction, right? So let's start. So now all the digital payments in India now will require a two-factor authentication, right? Two-factor authentication. That means if you want to authenticate a transaction, you need to do it via two-factor, right? Earlier, no such method was mandated here. However, the ecosystem has widely adopted the SMS-based OTP. And whenever you are making any transaction, maybe via your mobile banking or maybe via your internet banking, again, you need to also type the password or the PIN, and then OTP verification is also there. So one verification is your password, second factor is your OTP verification, right? So RBI has exclusively released these directions now to allow users of the alternative authentication mechanism and to provide the broad principles of payment authentication, how we can authenticate the payments, right? Let's first discuss about the scope of this particular guideline. So this is applicable only on the domestic transaction. It is mandatory on the domestic transaction plus certain cross-border card transactions for the Indian issued cards. So it will be applicable on the domestic transaction. It is mandatory. It is also mandatory for certain cross-border transactions if you are making it through card for the Indian issued cards, right? And the effective date here is 1st of April 2026. So as of now, it is not effective. It will be applied from the next coming financial year, right? 1st of April 2026. So here we can see the applicability as well from the circular. It is applicable to all the payment system providers. Those providers who are providing the payment system services, it is applicable to all the PSPs, payment system providers, and the payment system participants. So the regulatory bodies will be the payment system providers, and the payment system participants will be your banks and non-bank entities. Basically, the financial institutions are going to be your payment system participants, right? So it's applicable to both, plus cover all the domestic transaction and that particular cross-border international transactions as well for Indian issued cards. So there are certain definitions in this particular circular, like every circular, and the definitions are quite straight. The first thing is authentication. Now, what do you mean by authentication? It's nothing but verifying that you only are doing the transaction, right? Let's suppose I logged into my net banking. Now that net banking, that particular, my bank needs to know that whether I am authenticating the transaction or not, right? It's very well within my authority. So verifying and confirming the credentials of the customer, definitely how the transaction will be authenticated. They will ask me for my credentials related to my card or related to my PIN number and so on. Then card not present. If the card is not present, right? Let's suppose you are making an online shopping transaction. So I'll authenticate using my card detail. If it's a ATM transaction, I'll be entering my ATM PIN to authenticate the transaction. If the card is present, then what I'll be doing, I just swipe my card, right? That will authenticate the card. Cross-border payments, card issued by the Indian banks are used at the merchant overseas or acquirer. So let's suppose there is a forex outflow as well. So it will be a cross-border CNP transaction here, right? Factors of authentication. So factors of authentication can be definitely something user know, that is the ID password, right? PIN number. Something user has, it can has OTP. There are hardware tokens as well. If you guys know about hardware code tokens, right? You just need to insert a hardware and the transaction will be authenticated. It works like, you can take an example of digital signature, right? If I want to authenticate a document, what I'll do is I'll insert a pen drive which is having my DSC, digital signature certificate, and the document will be authenticated. Something user is, so biometric, via biometric also, like I place my fingerprint or Aadhaar or Face ID, it will authenticate the transaction, right? So what are the principles of authentication which is stated in this direction? Let's study this. Now the very first principle for authentication is minimum 2 factors are required to authenticate the transaction. Minimum 2 factors are required to authenticate the transaction. So that's what 2-factor authentication is all about, right? So now the issuer may let the customer choose their authentication. However, one factor should be dynamic. One factor should be dynamic. The other one can be static. Now what do you mean by dynamic and static? Static means it will not change, and dynamic means it will keep on changing with every transaction. So let's suppose if I talk about your password, it won't ever change, right? At least for a fixed certain period of time. So with the number of transactions, it won't change. Let's suppose I'm doing 50 transactions per day. I need to put the same password. That's a static factor verification. That's the factor number 1. One more factor. The second factor should be dynamic in nature, right? At least one of the factors should be dynamic in nature. It can be OTP as well, right? It can be OTP as well. Say for example, one-time password. So with every transaction, we'll be having a new OTP. That's why we call it as a dynamic, right? So at least you need to have 2-factor verification, out of which one factor needs to be dynamic. So 2-factor authentication is compulsory now, plus one dynamic. Out of 2, one should be dynamic. So that's the core principle stated here, right? Then one of the factors of authentication is compromise. The other must remain reliable. So that's why there is a need of 2-factor authentication. Maybe your password is leaked, still you do have OTP. Maybe your OTP is leaked, still you have the password, right? Interoperability and open access. So there should be interoperability here. Authentication or tokenization service must be accessible across the app. So you can access that particular authentication across the app for multiple requests, right? For multiple requests. Say for example, you are using the your password in the HDFC Bank mobile application. So that password is unanimous, that is interoperable in the net banking as well as in the mobile banking, right? Operating environment, it can be device hardware, it can be OS, etc., right? It can be tokenized as well. Say for example, my DSC signature, I can use my tokenized hardware to authenticate that particular transaction, right? Or maybe a particular document. There should be a risk-based approach. There should be a risk-based approach. Now what do you mean by risk-based approach? When the risk is high, the authentication will also be of high level, right? The security of authentication should also be of high level. So the issuer, the banks may apply extra check for risky transaction. Now maybe due to your transaction location or your device attributes or your behavior pattern. Let's suppose I only use my mobile banking for certain small transactions. So in the past 6 months, I have done a transaction of less than 5,000. Now if it's a transaction of maybe 50 lakhs, it's huge, right? The issuer may apply additional restriction. Why? Because my behavior pattern is changing. My behavior pattern is changing. I always do a transaction of less than 5,000, say for example. Now I am doing a transaction of 50 lakhs. So can I say that there is a change in my behavior now, in my transaction pattern? So this is a high risk transaction. The user can apply different several checks as well, additional checks as well for this particular transaction. Now high risk transaction may also use DigiLocker for the notification or for the confirmation, right? Say for example, if you usually shop from India, but say for example, if you are shopping from a foreign site, maybe based out of US, then the bank can demand extra authentication for you because there's a change in the behavior pattern here, or maybe the transaction location, right? Responsibility will always be of the issuer. What kind of responsibility? If issuer, say for example, HDFC Bank has launched a mobile application or has given a service of internet banking, then the robustness and integrity should be there, right? The robustness, the strength and the integrity should be there in the application and in the website that enables me to do a transaction, that too a transaction full of confidentiality, full of integrity, so that no kind of fraudster can be there, right, in the transaction. So that's why the whole responsibility is of the issuer. In case of any fraud, the issuer needs to compensate fully. So RBI has clearly stated here, in case of any fraud due to non-compliance, let's suppose a particular bank is not complying with the robustness standards or the integrity standards or the authentication standards stated in this particular direction, it will be the full responsibility of the issuer and not me. Not the user, but the issuer, that means the regulated entity, right? Again, obviously, you need to do the compliance with the Digital Personal and Data Protection Act 2023. Why? Because you are doing a digital transaction. In case of a cross-border transaction, the directions not apply to the general cross-border transactions, but for cross-border CNP transactions, issuer must, by 1st of October 2025, validate the non-recurring CNP. What is CNP? Card not present. If the card is not present, you need to first validate it by 1st of October 2026, where authentication is requested by the overseas merchant or acquirer. Then you need to register your bank identification number as well with the card network and adopt a risk-based mechanism. So this is for the issuers, right? If by 1st of October 1st, you need to validate your non-recurring CNP transactions. Let's suppose this transaction is non-recurring that I'm doing and the card is not present physically. So I'm making an online transaction, right? So first I need to validate this kind of non-recurring transaction where authentication is requested by the overseas mercantier, right? Then in the next one, we are having some of the transactions that are given exemption from the two-factor validation, from the two-factor authentication. That means in case of these transactions, you are not required, the two-factor is not compulsory, right? You don't have to do the two-factor verification like small value contactless card transactions where you just tap and pay, right? Where you just tap and pay with the card. Recurring transaction under the e-mandate, let's suppose any kind of OTT subscription where you have already established, where you have already set a mandate, right? So in that case, you don't have to again and again do the two-factor authentication. That's already verified by a mandate. Then select prepaid payment instruments like gift cards and prepaid payment instrument of MTS. NETC transaction like National Electronic Toll Collection. So basically your fast tags and all, you don't have to go for two-factor authentication. Small value offline digital payments and travel bookings via the GDS and IATA using the corporate cards. So these are some of the exempted things that are there in the notification. So this can be important. Okay, please do remember this one can be important for your examination, right? Next, I have given you the summary as well for this particular circular. Next one, investment by the state cooperative banks, STCBs and central cooperative banks in a shared service entity. Now the shared service entity is established by NABARD. This shared service entity is established by the NABARD. So first we'll have a brief understanding of what this circular is all about. Then we'll be understanding this circular. Okay. So let's have a quick background. Every regulated entity needs to have statutory liquidity ratio. They need to maintain a specific statutory liquidity ratio, right? A certain portion of their NDTL, net demand and time liability, in the form of liquid assets. So now it can be cash, it can be gold or any other approved security. So the approved SLR securities, anything except the approved SLR securities will be other securities, right? Other than the approved SLR securities. So if you are investing in approved SLR security, that's great. You'll be getting the you'll be getting the coverage in the SLR, right? But if you are investing in other SLR security, there used to be a restriction. There is still a restriction, right? In 2016, RBI has issued a particular circular. The types of non-SLR securities, the types of non-SLR instrument in which the STCBs and CCBs can invest. It's not like that you can randomly invest in any security. If that's an approved SLR, that's fine. You can invest in it. If it's other than SLR, other SLR approved securities, then you need to have a look at the 2016 RBI circular. The types of non-SLR securities instruments in which the STCBs and CCBs can invest. So there is a list of those securities, right? And there are some prudential limits plus restrictions as well on the investing in the unlisted securities. Right? Now, NABARD has launched SSE, shared service entity. Now, this is very, very important for your examination. So, if you are a state cooperative bank or a central cooperative bank and you have invested in shared service entity, which is a non-SLR security. It is a non-SLR security. Now, if you are doing so, no problem at all. It is very well within the range of other approved non-SLR security, because non-SLR security के अंदर भी you have two categories, whether you are permitted or not permitted. So this is a permitted one. Okay, RBI is just giving a clarification that this particular SSE investment established by the RBI, shared service entity investment, is permitted. Right? It is definitely a non-SLR one, so that's why it is permitted. So there is a category of permitted and non-permitted. This is not at all from the non-permitted category, is what written here. The circular specifies the permissible non-SLR investments. Right? We are talking about the 2016 circular. So RBI has accordingly given the regulatory approval in April 2025 to NABARD's shared service entity for STCBs and CCBs, wherein they can subscribe to the equity shares of the SSE. So they can subscribe to the equity shares of this shared service entity, right? And there is no need for any kind of review as of now. So it will be definitely a non-SLR investment, but it is permitted. It is permitted, right? So that's what the circular is all about. So NABARD has established a shared service entity in which you can definitely invest in the equity shares of this SSE, and that is definitely a non-SLR security, but it is permitted. Here, right? So additionally, they have given a cap as well of 5%. Any single bank investing in SSE's share capital, there is a cap of 5%. Whatever your own funds are, you need to have a maximum cap of 5%, not more than that. So this can be important. The first thing is, if you are a STCB or a CCB and you are investing in the equity shares of the shared service entity established by NABARD, this is a non-SLR security. Still it is permitted. This is the first amendment, that it is permitted. But there is a cap. There is a cap of 5% of your own funds. So please do remember this thing. Okay, please do remember this thing. Right? This is all about this particular circular. That's it. Next one is a special clearing in the check truncation system on 3rd of October. So we all know that we have transitioned from a batch processing system to a continuous clearing. I'm talking about the check truncation system. Earlier we used to follow the batch processing system. Now we have transitioned to the continuous clearing system. So that's why we are transitioning from 4th of October. 4th of October is the first date from which we are transitioning, right? That's the phase number 1. Tell me the phase 2 date in the examination. Not your RBI Grade B phase 2. I'm talking about the check truncation system phase 2 implementation date. Phase 1 date is 4th of October, right? 2025. So that's why there is a special clearing session on 3rd of October, right? It is just for 3rd of October, just for the preparation purpose, because we are going live from 4th of October 2025 to the continuous clearing system, right? So here we can see on the 3rd of October, there will be the written session for the presentation done on 1st of October, 8 a.m. to 10 a.m. will be the timing. Special clearing presentation session will be from 11 a.m. to 3 p.m. and special clearing written session will be from 5 p.m. to 8 p.m. So that's just for a particular date, which is 3rd of October, and then we'll be going live from the 4th of October, right? The time and everything which we have studied in the circular will hold true. This is just for your 3rd of October. That's why we call it as a special clearing session, right? Special clearing session on 3rd of October. Just for the preparation purpose, because we are going live from 4th of October 2025. Next is the release of your supervisory data quality index for your scheduled commercial bank. Now this is not a RBI circular. It's a data published on the RBI website, right? We cover both the circulars as well as the data published on the RBI website. That's why these sessions will be very, very fruitful for your upcoming RBI Grade B examination. So last time when the data was published, that was related to March 2025. Now we have the data of June 2025. So the data of June 2025 will be very, very relevant for your examination, right? It was published on 24th of September. Let's quickly have a look at the data. Supervisory Data Quality Index, SDQI is the full form, right? SDQI, Supervisory Data Quality Index for the period June 2025. So it evaluates the quality of data basically submitted by the regulated entities. The regulated entities, different banks are submitting their data to the RBI. So we need a quality check. So the SDQI is nothing but a quality check of how well the data, whether the data is accurate, what is the timeliness, completeness of data, and consistency of data. So on 4 parameters, SDQI is evaluating the data accuracy, timeliness, completeness, and consistency. Whether you are giving the data accurate, whether the data has been provided on a timely basis, if the data is complete or incomplete, and 4th one, whether you are consistent, in giving the data, how consistency is there in the data or not, right? Or the data is completely inconsistent as compared to the last time. So on these 4 broad parameters, we are calculating an index SDQI, which will tell whether your regulated entity has given a adequate data quality control or not, has kept adequate data quality control or not on the published data to the RBI, right? So here we can see, I'm talking about the scheduled commercial bank. The SDQI score used to be 89.3. I'm talking about March 2025. And in June 2025, the data has even increased. Now the new SDQI score is 89.9. सर हमको कौन सा स्कोर याद रखना है? तो इतना बड़ा जो लिखा है ना मैंने स्कोर, ये वाला आपको याद रखना है, ठीक है? 89.9, which is the recently published data. Earlier it used to be 89.3, right? There is an increase of 0.6 here in this particular score. So now the current data is 89.9. Okay, can be important for your examination. And if I talk about the individual parameters, the scheduled commercial banks are outperforming here. We can see in the completeness, right? The completeness is having the highest number, the index number, as compared to the rest of the other parameters, right? And the same was there in the March as well. In the March as well, we are outperforming in terms of completeness, and in the June as well, we are outperforming in the terms of completeness of data, right? If I talk about public and private sector bank, so the SDQI score, they both are at a tie. 90 का score है public sector and private sector banks का. Foreign banks का 89.7 and small finance bank का 90.7. So can I say that among this category of public, private, foreign bank and SFBs are outperforming with the data of 90.7, right? SFBs, small finance banks, are outperforming with the data of 90.7. So that's amazing. So that's basically the data here. Now we can have a look here. The blue line is less than 70, which is major concern. Between 70 to 80, you need improvement, and between 80 to 90, it is acceptable, and more than 90 is exceptionally good, right? So that's the criteria here. And now if we talk about the parameters here, we can see that the completeness parameter is outperforming each and every different parameters, right? And the SDQI score is now 89.9 as of June 2025. So again, it's there in the increasing trend, and we can see continuously an increasing trend quarter on quarter basis, right? Next is again related to your WMA. What is WMA? Ways and means advances, right? So this is advances that are being taken by the government of India to match the cash flow mismatches. In case there is any kind of cash flow mismatches, then government of India is using the WMA limit. So the WMA limit for October 2025 to March 2026 will be 50,000 crore. Okay, 50,000 crore for October 2025 to March 2026. Right, please do remember this, can be important for your examination. This is for the second half of your financial year 2026. This is WMA limit for the government of India, right? And the RBI may also trigger fresh flotation of market loans when the government of India utilizes 75% of the WMA limit. Let's suppose the government of India has utilized 75% of the 50,000 crore. Then the Reserve Bank of India can advise definitely the government of India that they can use some other kind of facility rather than just using the WMA facility. This is all about this particular news. You need to remember this particular data of 50,000 and this 75% utilization limit. This is for the second half year financial year 2026, right? So that's all for in the part 1, guys. I'll be covering the rest of the things in the part 2. Soon it will be out as well. So guys, if you are preparing for the RBI Grade B examination phase 1, here is the rapid revision batch for all of you. Have a look at the course highlight. We are covering each and everything here, right? That can be very, very important for your phase 1 examination. So you can enroll in it. So thank you so much guys. Bye bye. Take care. See you soon in the second part.